So where does this buying and selling pressure come from? Well, it comes from investors. But there's two different types of investors. There's retail investors and there's institutional investors. Now, a retail investor, someone that does not trade the stock market as a professional. They're everyday people. They're someone just investing for themselves. And a small amount of the overall buying and selling in the stock market is performed by retail investors. Most of the buying and selling pressure, most of the buying and selling every day is done by institutional investors. And an example of an institutional investor is someone investing other people's money, like a hedge fund or a pension fund, mutual fund, anything like that. So why does this matter? Well, institutional investors can move stocks very quickly. They have a lot of money and they can buy a lot of stock quickly, or they can sell a lot of stock quickly during regular market hours. And regular market hours, if you're not familiar, 9:30 a.m. till 4 o'clock p.m. Eastern Standard Time or New York time, Monday through Friday. Of course, they're not open on holidays, or certain days might be a half day where the market's open 9:30 a.m. till 1 o'clock p.m. But for the most part, 9:30 a.m. to 4 o'clock p.m. is a normal trading day. But perhaps you've heard about the pre-market. The pre-market is between 9 o'clock a.m. and 9:30 a.m. And institutional investors can actually buy and sell stocks before the market even opens. Most retail investors, they don't have the opportunity to purchase and sell shares in the pre-market. And the exact same thing occurs in the after hours. The after hours is after the market closes, after 4 p.m. The after hours is between 4 p.m. and 8 p.m. And institutional investors, they can do some buying and selling during that time. Retail investors, not so much. And why that is important is it can create gaps from this after hours buying and selling pressure or the pre-market buying and selling pressure. Let's take a look at a gap down example. Let's take a look at Joy Global Inc. So we can see end of November, the stock closed around $15.25, just as an approximation. We can see the first day of December, the stock opened for trading $14 around 50 cents, and it went down from there. Lots of selling pressure. The selling pressure exceeded the buying pressure in this situation. And as a new investor, what you want to realize is the markets can move very quickly. And just because a stock closes at $15.25, it doesn't mean the next day you can necessarily get $15.25. No, the next day in this case, the maximum you could have got was only about $14, maybe 40 cents or 30 cents. Like, you can lose a lot of money quickly with a gap down situation. The gap down situations, they're caused by institutional investors. But at the same time, there could be a gap up situation. Here's a stock, Terraform Power Inc. The stock closed end of the month, November, around $7. And the stock opened for trading around $8. So there was lots of buying pressure after hours in the pre-market, and the stock took off from there. So it goes both ways. Of course, if you're long a stock, a gap up situation is great. If you're short a stock, a gap down situation is great. But you got to be very careful because these institutional investors are very powerful.